Today's lesson will be from Chapter 8. We're going to look at exercises 8, 9, and 10. I'm sharing with you some information for exercise 8. What we're going to be doing today is a marketing expense budget. And for a marketing expense budget, we're going to anticipate the expenses, of course, of marketing for the new period of time. And we generally break these down into variable expenses and fixed expenses if we have those. So in this particular problem, Timothy Donaghy has developed a unique formula for growing hair. His proprietary lotion, used regularly for 45 days, will grow hair in bald spots with varying degrees of success. Timothy calls his lotion Hair Again and is selling it via the telephone and internet. His major form of marketing is through a 15-minute infomercial and internet advertising. Timothy sells each 16-ounce bottle of Hair Again for $15 and pays a commission of 3% of sales to telephone operators who field the 1-800 phone calls from potential customers. So this commission is a variable expense, so you need to know that. Fixed marketing expenses for each quarter of the coming year include the internet banner ads, telephone operator time, and travel. In addition, early next year, Timothy intends to film the show infomercials on television. He expects the cost to be $10,000 in quarters 1 and 2, and the cost will rise to $25,000 in each of the 3 quarters 3 and 4. So this is what we refer to as a step fixed cost. It's going to be fixed at $10,000 for 2 quarters, and then it's going to rise up as in step fashion to $25,000 for quarters 3 and 4. But it is a fixed cost and will go with the fixed expenses. Timothy expects the following unit of sales of Hair Again. In quarter 1, 5,000 units are going to be sold. That's what they're expecting. Quarter 2, 15,000. Quarter 3, 40,000. And quarter 4, 35,000. And what they want you to do is to prepare a marketing expense budget for the year. So we're going to start with our budgeted unit sales, and those were given. I just plugged these in for each of the 4 quarters. Then I made a total column and I added all of these together to get total sales in units for the entire year of 95,000. The unit variable expense you have to figure, and the way that we figure the unit variable expense is we're going to take the variable cost, which was the commission, and remember it said that it was 3% of the sales. So in order to find a unit variable expense, we would need to know what the selling price was per unit. And it is $15. So we'll multiply $15, the selling price per unit, times 3%, and that will give us the amount of 45 cents. And that 45 cents is our variable cost per unit that we sell. So notice what I did here is I carried over that 45 cents into each of the quarters. And the total is still going to be 45 cents because that variable rate per unit is staying the same. So for each quarter, it's exactly the same amount because this is the unit cost of the variable expense. and it will stay the same throughout the time period. To find the total variable expense, we would multiply the cost, the variable cost per unit, not the variable cost per unit, but the percentage that we came up with at 45%, or actually it's 45 cents if you took $15 and multiplied it by 3%. So 45 cents times each one of the sales for each quarter are going to give you your total variable expense. So 45 times 5,000, 45 cent times 5,000 gives you $2,250. This is a dollar amount here that they were wanting. Multiply 45 cents times 15,000 for the second quarter, and I'll give you $6,750. 45 cents times 40,000 will give you $18,000. And then 45 cents times 35,000 will give you $15,750. And then what I did is I added all the way across, and I got a total amount of my variable expense for the whole year at $42,750. And then what I did is I put down my fixed cost, and the fixed cost started out like this. And I know I've got mine in a little bit different order, and it doesn't matter which order they're in. You could have just copied and pasted these in if you wanted to, but you have to add in a line for this separate fixed cost that they talked to you about right here, where he expects the cost of the filming of the infomercials to be 10,000 in quarters 1 and 2, and the cost is going to rise to 25,000. As long as you've got that somewhere in here, you can put it anywhere you want to. I just happen to stick it in the second line here. So make sure you do add what was coming across for your filming of your television infomercials, which I called that television there. And so basically, if it's a fixed cost, it stays the same throughout the period of time. But remember, this television infomercial is going to cost us more in quarter 3 and quarter 4. They gave us that information. So the remaining fixed costs are the same, and then we picked up 25,000 for the television infomercial. And for quarter 4, it's also going to be 25,000 for that television infomercial. So those are your fixed costs there. You simply total them together, add these up, and add them across, and that'll give you the totals here. Now, to find the total marketing expense, the bottom line here, you're simply going to add your variable expenses for marketing plus your fixed expenses for marketing together. So 2250 plus 24,600 is how they came up with 26,850. And you do that for each quarter. And the total, of course, would be this plus this, gives you that. Now, in the second part of this, they give you a what if analysis. And they say, what if the cost of the internet ads rises to 15,000 in quarters 2 through 4? So what we have to do is we'll have to change the internet ads. It stayed the same in quarter number 1, but in quarter 2, the internet ads are going to increase here to 15,000. So the remainder of this budget is exactly the same. So all I did is copy this budget down here and then plugged in what was different. The internet ads in quarters. Notice it says just quarters 2 through 4. So quarter 1 was not affected. So I just had to change it right here, class. Put in the amount. And then the rest of it operates the same way. And then they had a question for you that they wanted you to answer. And the answer to that question is right here in bold. If the cost of the internet ads rises to 15,000 in quarters 2, 3, and 4, then since that was a fixed cost, the fixed marketing expenses in those quarters will be higher by the amount of $7,400 each month. So in other words, we went from 7,600 to 15,000 here. So each month we had an increase in our internet bad ads, banner ads of $7,400. It would not change the variable expenses. Notice they stayed the same. So because my fixed cost changed in quarter 2, 3, and 4, my fixed costs will change, and the total of your marketing expenses will change because the fixed cost also changed. So let's look at exercise 8.9. Exercise 8.9 is also doing a marketing budget. Actually, it's an administrative expenses budget. I'm sorry. I've got it down as marketing. And this should say administrative expense. It's an administrative expense budget. It's going to be done very similar to your marketing budget. That's probably why I had marketing on the brain here. So let me change this for you. All right. And so your administrative expense budget for the Green Earth Landscaping Company is going to be prepared for the months of June, July, and August. They told you that. And they only had fixed expenses here. So they could have had some variable expenses, but they chose only to show the fixed expenses. And since these were fixed, all I did is copy this into each one of the months here. And then of course I added a total column, and you'd total straight across to get those. And then I added a total column for the administrative expenses, which you add these straight down to get this. So this one's very simple to prepare, nothing difficult about it at all. They also gave you a what if analysis for this one, and it says, what if Green Earth Landscaping Company insurance rates increased at the beginning of July, notice it's just July, to $2,600 per month. So July and August are going to be $2,600 per month, whereas before they were $2,500 per month. Everything else stays the same. So the increase in insurance rates at the beginning of July will increase the total administrative cost by $100 in July and August. So each month is going to increase by $100. And the last problem that I want to talk to you about on this particular video is the budgeted income statement. The budgeted income statement follows the income statement format. So you can see here sales less cost of goods sold gives you gross profit. Then you're going to record your operating expenses, which consist of selling expenses and administrative expenses. And then you'll add your selling and your administrative expenses together to get your total operating expenses here. And then your operating expenses are subtracted from your gross profit to get your operating income. And then this is a corporation. This will be a little bit new to you, but corporations pay income tax. So we'll have an income tax expense account that we're going to have to put in here. And then we'll deduct the income tax expense from the operating income, or sometimes it's referred to as income before income tax, and that will give you the net income. So basically, they've given you the information for Coral Seas for a year, and they're going to be selling jewelry, costume jewelry. And the expected sales are going to be 15,900,000. So you put that in your budget to start with for your sales. Your cost of goods sold is 8,750,000, and you simply subtract your cost of goods sold from your sales to get your gross profit. Gross profit is what you have left to cover your operating expenses. And they have marketing expenses, which is a type of selling expense for the year, is budgeted at 2.8 million, which is 2,800,000. That's what I put here. And then they've given you that the administrative expenses are expected to be 675,000. So they're just giving you the total amount of those administrative expenses. We could have broke these down, and companies would do this if they were working on a budget. But here they just took a shortcut and put the total selling expenses in and the total administrative expenses in. The two of these combined are the total operating expenses, and operating expenses will be deducted from the gross profit in order to give you the operating income, which in this case is also your income before income tax. Then they told you that the income taxes are paid at the rate of 40%, is 40% of your income before income tax, or in this case, it was operating income. So I simply multiplied 3,675,000 by 40% to get the income tax expense for this company. In the real world, the companies will actually fill out their own tax returns, and that's where the amount of the income tax expense would come from. The difference between these two are your net income. That's your net income for this period for the coming year. And then in part two, they give you a what if analysis. What if Coral Seas had interest payments of 500,000 during the year? Interest payments are other expenses, and they are not going to affect your operating expenses, but there's a separate category that would go on your income statement. And that category is right below the operating income. You would list your other expenses, revenues, gains, or losses. Those are some of the categories that can go in this is really other items, if you want to call it that. But in this case, we just had one interest expense that we needed to record, and the amount of 500,000 was given. This other expense is subtracted from your operating income to get the income before income tax. So notice that it's different than the one that I put up above, because there was no other revenues, other expenses items. There were no other items at all. So in the previous example, the operating income is the same as income before tax. However, in the what if analysis, it is not. The operating income is separate from the income before income tax, because you had to put in this other item or this other expense category for interest expense. So because you had an other expense, it will decrease the amount of your net income. So your net income is going to go down to 1,905,000. So the effect that it will have on operating income is that the operating income won't change. The income before income taxes became this. And then on net income, the net income went down to this amount. And that's all I want to talk to you about today. I'll see you again in another video. So I'm gonna stop sharing this with you. Bye-bye.